This is the Opal Dividends Podcast with Austin Graff and Adam Muller. My name is Jay Coulter, and today we're going to discuss conflict in your portfolio and the potential spread of that global conflict. Inflation narratives. We're going to discuss utilities, TLT, and energy in your portfolio. Let's get started. Adam, when you look at the conflicts that are brewing across the globe, what should investors be thinking about as it relates to their portfolio?
Yeah, that's a great question. And let me start by saying that obviously there are some terrible things happening in the world today, and we don't want to comment on our specific political views. But no matter what you think, you have to stop and think about your investment portfolio, because the stocks and the bonds and whatever else you own doesn't stop trading just because a conflict breaks out somewhere in the world. So I think it's important to remember that markets tend to have a knee-jerk reaction when a geopolitical event comes seemingly out of nowhere. So don't panic. Don't sell because things are down. Don't sell if something's up. If you have the right portfolio, it should be able to withstand that initial sort of panic moment, and you should stop and think and assess what's going on. Think about what region of the world are we talking about? What commodities are affected, and how could that play into your portfolio? But if you have companies with strong balance sheets that are good, solid businesses, chances are the right reaction is to do nothing and ride it out.
Austin, I'm going to pull up a chart here. This is a 2-year chart of TLT and the Qs. I've been getting a lot of calls from my advisor network about the frustration they're having in client communications with regards to the drawdown in the bond market. What's the right way to look at this chart and position communication with investors?
Yeah, I think it's a really interesting chart, and it has a lot to say about duration and the disconnect between the equities market and the fixed income market right now. So if you look back 2 years, essentially this is around the time that the Fed started increasing interest rates at a pretty aggressive pace. And for the first, I guess, about year through 2022, you saw higher duration equities in the QQQ and higher duration fixed income and TLT move in the same direction. They both moved down pretty aggressively through 2022. And then as we enter 2023, you see this unique moment where TLT continues further down, going down another 10% through the year so far. And then you see the Qs recover almost 100% of their value that they lost in 2023. And it's a unique dynamic. I think a lot of it comes back to many advisors are focused on a 60-40 portfolio, and it's been a huge kind of tailwind for many portfolios for the last 30, 40 years. And a lot of that had to do with the fact we were in a pretty long bull market for fixed income. So at any point in time where there was a slight hiccup in the economy, officials tended to try to drive interest rates down through monetary policy to support the economy going forward. That often offset the decline in equity prices in that moment. We're not in the same situation today, as we don't have the luxury of pushing rates below zero. So the Fed had to reset rates to a higher level, and that's where we've seen this disconnect between equities and fixed income. I'm not saying that the relationship is dead forever, but it does seem to be at least not the most reliable in the current moment, as we've seen interest rates rise and we've seen equities act in a different way. So I think going forward, investors need to be more selective in how they think about hedging out their equity exposure, and it can't just be kind of broad-based fixed income expected to bail them out in any time of need.
Adam, I completely cherry-picked that chart. So if you're an advisor today or an investor looking at using fixed income to hedge your equity exposure, what concerns should you have, to follow on with what Austin was saying? And is it still a viable solution for a portfolio?
Look, I think there's still a place for fixed income in a portfolio. Absolutely. You just have to be much more cognizant of duration. You can't just go buy anything. If you buying some mutual fund where you don't understand the duration, or they're going to be trading around positions, could create a lot of problems. But if you just go to a If you just go and buy short-dated U.S. treasuries and ladder them and just keep rolling them over, you could capture a nice 5% yield and still have that low duration optionality as things play out and see what happens. And if then you're concerned, but what if rates come down? I won't have locked in a high long-term yield. Yeah, but if rates come back down, the equity portion of your portfolio might be doing so well that you won't care.
Yeah. Austin, here's a chart of MUB, which is the iShares National Muni Index, just as a proxy for intermediate duration muni bonds. The technical chart here is complete carnage. Is this something that long-term investors should consider legging into?
I think blanket exposure to munis right now is difficult. Again, you're talking some duration exposure, but you're also talking, many of these munis have potential fundamental issues because the different governments that are backing their payments may have issues with debt loads, may have issues with taxing authority, may have issues with general demand. And I think we might be in an environment where you're seeing, some of the fundamental issues pop up, and that's what's driving the price action for broader indices. I think investors need to be more selective in which munis they own and make sure that they own munis that have revenue profiles that are supported by current prices, rather than just purchasing blanket portfolios expecting to take advantage of some change in the market.
Yeah, research.
If I wanted to lower my overall tax burden, I would advise you, I'd move to Florida before I'd buy a muni fund. Just get rid of that state tax, and you'll, instead of just buying some bucket of crap.
Yeah, and it really speaks to active management again in the muni space if you're going to be allocating there.
Florida's not that bad either. I mean, it's a great place to live. Great quality of life.
But hard to find a house, which, Adam, brings me to the next question. You look at the housing market today, which is such a huge part of the economy, and you look at 30-year mortgage rates at 8%. What type of drag is this putting on the overall economy, and how does it affect portfolios?
Yeah, I think there's lots of interesting effects because of where the mortgage rate is at. If a large percentage of Americans that own their homes have rates locked in at below 4%, so they're not going to be moving anytime soon. So most of the sales of existing homes are going to be to cash buyers, and that's a very limited subset of people, which is a very interesting dynamic for home builders, for example, because the demand for new homes then rises. Because there's not enough, the supply demand is out of whack since no one wants to sell. And then you've also had the dynamic since the global financial crisis of sort of institutions building businesses around buying a bunch of homes and renting them out. And they're now having problems turning over their housing inventory or adding to it. So there's lots of things going on, but I think the net result is that the impact of higher rates on the housing market into the economy just hasn't happened at the rate it normally does in a Fed interest rate hiking cycle.
All right, I'm going to put up on the screen here a quote from Nobel laureate Paul Krugman. It's from X, and he really stepped in it this week. He posted that the war on inflation is over. We won at very little cost, and showed a chart of CPI, X, food, energy, shelter, and used cars. Gentlemen, he got killed on X. Did he deserve it?
I'll tell you what, when I first saw this post, I thought Krugman was being sarcastic, because it's either that or someone slipped something into Krugman's chamomile. Because if you exclude everything that people spend money on, of course, inflate. Like if someone said to me, "Hey, Adam, are you experiencing higher prices when you buy stuff?" I'd say like, yeah. And they're like, "Well, what have you excluded everything you spend money on?" I'm like, "Well, then it's been flat." So it doesn't, I don't know if this makes much sense.
Yeah, I think it's like the stupidest thing I've seen in quite some time from someone who's probably not as dumb as the chart would indicate. It's an interesting perspective, and some of it's led to, it's kind of this creep that I guess economic PhDs have been using for some time, trying to find new ways to define the market, where they went from headline inflation to core inflation. And essentially they just pulled out everything that has higher prices than what they would like to see. And so if you look at kind of bankrate.com, they say that the average household spends about 60 to 65% of their budget on housing, food, and transportation. Those happen to be the three parts that they pulled out for this CPI equation. It's essentially like bringing a report card home to your parents and saying, like, hey, I got straight A's if it weren't for all the B's and C's on the report card. It makes no sense. Your parents aren't going to buy it, and neither apparently did the people on X. So I think that the economists need to stop trying to come up with quirky new ways to define things and just live with reality.
Also, it says the at very little cost thing is also very disappointing from Krugman. At very little cost. I don't know how much Princeton pays Krugman, but go talk to some small business owners that require loans to run their businesses. They are suffering, if not having to shut down completely. There's been it's not the global financial crisis type of cost, but there is a big cost to these rates. You just don't see it in large S&P 500 companies, but in small businesses, which is the majority of business, they're suffering, and it's really difficult right now.
I would argue you're seeing it in big businesses, but it's just been delayed because the Fed signaled for so long that there were going to be rising rates. So if you look at the UAW and the Big Three negotiations, right, no one's going to win there. If you look at the
Tesla is.
Yeah, well, Tesla, and foreign automakers, right? So no one in the U.S. is going to win from that.
Right.
You look at
consumers,
the Kaiser Permanente issue, right? Like no one is winning from consumers paying much higher rates to compensate people that feel that they need to get 30 and 40% increases in wages. So to say that there's no cost, it just shows that it's another academic living in a bubble and not understanding what's going on Main Street.
And don't forget the actors' strike. I'm really worried about George Clooney. What if he can't sell his Lake Como property,
Gentlemen, let's move on to the bull and bear segment. So viewers, this is where Adam and Austin have 60 seconds or less to give their opinion on whether this asset class or stock is in a bull or bear position today. Austin, let's start with you. Utilities, bull or bear?
I think utilities are currently in a bear market, but we like them. We think that they're a great opportunity to buy. If you look at many of these utilities, you're getting some benefit from the Inflation Reduction Act as the government's putting more money into green energy. It's driving growth in earnings that these companies have struggled to find historically. Many, I would say, select utilities are identifying growth in the 6 to 9% range, which will lead to attractive yields today, dividend yields today, growing at high single-digit rates. And we think that's an attractive profile. Many investors are overlooking it today because they're looking at the static dividend yield compared to a static yield on a U.S. Treasury. And we think that that's the wrong analysis for an investor who's going to hold a stock for more than 12 months.
Adam, bull or bear on Target?
Yeah, I'm a bear on Target. I wouldn't touch Target with a 10-foot pole that I could probably buy at Target. I think it looks cheap versus its historical multiple. But there's so many problems going on. You've got 40 million Americans that are now paying their student loans again for the first time in 3 years. You've got this leakage problem, which the company has talked about, theft, but it sounds like there's more to it than that. But what is that? And the U.S. consumer that a year ago was flush with cash isn't as flush anymore. And it doesn't feel like things are getting better. Things are continuing to get worse. So while it looks cheap, for me to be willing to take that risk reward, it would have to be cheaper still.
Austin, bull or bear on precious metals?
I don't think many people should be in the market just buying precious metals. The problem with precious metals is that they don't really provide any sort of cash flow. If you wanted to play the precious metals game, a better way of looking at it might be to buy the miners of precious metals. Many prices appear to be depressed in the current market as people are expecting, a declining economy in both China and the U.S. It might be a good opportunity to buy. We would say, though, you should buy the miners if you want to get involved and buy high-quality miners that don't have a significant amount of debt on the balance sheet because they have likely the most opportunity to benefit with the least amount of downside.
Adam, bull or bear on JP Morgan?
I'm a bear on JP Morgan, despite the earnings that were great. They beat on the top line, they beat on the bottom line. But when your CEO gets on the conference call and says, "Hey guys, we're over earning and this won't last forever," probably time to take your chips off the table. And the number that really struck me was the loan loss provisions. The credit was less than what was expected. And when you hear about, when it feels like the economy is deteriorating, then it's just a matter of time before we have a couple of quarters where the credit provisions are way higher than what the market expects. So look, great run, incredibly well-managed company. I'm not sure it's the time to be buying JP Morgan.
Austin, bull or bear on ConocoPhillips?
I'm kind of torn. I'm a bull on the energy sector in general because I think that there's the ability for oil prices to stay higher for longer than many people expect. Within that sector, I'm a bear on Conoco. And a big reason comes down to balance sheet quality. So they have more debt than most of the peers. It does seem like they're going to get involved in this acquisition game or the consolidation game going on in the Permian. And for them to do that with a higher debt load, it puts more risk on the balance sheet. So they'll be more at risk if oil prices decline. They also have a pretty robust CapEx profile over the next few years, again, creating more risk for the company as we go through what is likely going to be a relatively volatile oil environment or oil price environment. We think there are better opportunities with less downside potential where you still get decent upside in the space. And we would say that you should probably focus on those areas.
Adam, let's wrap up with Meta. Bull or bear?
Oh, I'm a bear on Meta. I think Meta should change its ticker again to Zuck because this is his company. And, Meta's gone from $90 a share to $320 in a year and a half. All because the CEO said he would waste less money and then said AI a few times on some conference calls. I don't think that's worthy of that kind of stock price appreciation. And the growth that the market seems to think is coming over the next 5 years, the earnings growth, where is that actually going to come from? And I think that's you've got to show me story at its current price. It might not be expensive based on its historical multiple, but at the size that it's at. And you can't just say AI and then generate revenue from artificial intelligence. You actually have to do something. So I think it remains to be seen. And I'd be very careful with Meta at this level.
Gentlemen, I appreciate you guys taking time to do this. Viewers, to learn more about Opal Capital, visit opalinvest.com and be sure to sign up for the Opal Dividends Digest, a weekly publication that Austin and the team put out talking about topics in the dividend investing space.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.